Good afternoon, and welcome to the November 2022 Executive Committee meeting of the Board of Education Retirement System. Today's Thursday, November 17th, 2022, and the time is 1:08 p.m. As a reminder, please note that the committee meeting is being recorded and will be posted to the BERS YouTube channel. Start the meeting by calling the roll. John Matterich.
Present.
Thank you. Benjamin Schoenbeck.
Hello.
All right. Allison Hirsch.
Present.
All right. We have a quorum. I'd also like to note.
Sorry, Antonio.
Yes.
I just want to flag that I will likely have to get off at around 2 o'clock, and John
Okay.
Dorsa, who's my alternate, is on and will stay on when I.
Absolutely. Thank you. So noting for the record that alternate executive committee member John Dorsa is also in attendance and will take over for Allison Hirsch when she needs to depart. The first item of business is to consider the minutes from the October 2022 executive committee meeting, a summary of which was included in your packets. Can I get a motion to consider?
Motion from John.
Thank you, John. Second?
Seconded.
Thank you, Ben. Any discussions on the October 22 executive committee meeting minutes? All right. All those in favor, may I have a motion to approve the minutes?
So moved.
Thank you, Ben. Second?
Second from John.
Thank you, John. Any further discussion? All right. All those in favor, please say aye.
Aye, John.
Aye, Ben.
All right. Any opposed? All right. Any abstentions? All right. Motion carries. So we have a pretty short meeting today. 2 items for discussion in public session and 1 item for executive session. The first item on the agenda for discussion is titled the Bear Market Redux, and it is in response to some questions and comments we received after the presentations last month. I think I can best categorize those questions into roughly 2 categories. The first being how to summarize the most important elements of the presentation, and then what does this analysis mean for decision making over the coming months. So in an effort to answer those questions, in your package, I took the liberty of putting the charts together that acted really as the framework for our analysis, and then made some declarations and statement about each of them. And then finally, getting into how does this analysis change or modify our recommendations and perhaps final decisions as they relate to asset allocation and policy. So I will share my screen. Please let me know if you can see my screen. Everybody can see it?
Yes, I see
We can
it.
see your screen.
Perfect. All right. So we'll start with some of the key takeaways from the bear market in attribution presentations. Like I said, we have slides that show the main I guess kind of analysis and how that relates to our subsequent recommendations. So the first 2 slides really just show that the international equity returns have underperformed forecasts for the past 20 years. So you can see here, as Salil showed last month, 10-year equity return versus assumptions, and then the 20-year equity returns versus assumptions. In both cases, international markets have underperformed. So, what does that mean in practice for our recommendations? I think the biggest thing is how much should we utilize those return forecasts in our allocation decisions to international equity moving forward, or should we use additional information to determine our global equity allocations? Both things that are more customized, so customized analysis that Salil has developed and has talked about over the past few months. Other analysis around geopolitics. Some folks participate in the Friday conversations that Steve Meyer sets up. But even more important, the trade-off that we have between international equity and private markets is pretty acute for us because they take up precious basket clause room. And so for us, we're saying we are going to use that additional information in determining that global equity allocation, in addition to the capital market assumptions that your consultants put together. Next, the slides 3 and 4 from my earlier presentation on attribution analysis and from the asset liability presentation that Siegel Marco advisors gave last year. Being overweight or underweight any asset class introduces unintended risk into the portfolio. So in this case, being overweight fixed income has hurt performance. And generally speaking, the policy portfolio has preferable risk and return characteristics in both the average scenario, and so the scenarios that we believe are most likely, but then also in downside scenarios. And that is shown in the appendix in the appendix slide 4 that showed under under both the downside and median circumstances, our policy portfolio has better outcomes than the portfolio we had back in 2021. And what does that all mean? That means everything else being equal, aggressively staying at target, particularly in growth assets. So particularly in equities, particularly in things like private equity and in real estate, over the long term is preferable and is our outlook. And I think it's important that we always advocate for ways to get to that policy. For us, again, what is most important is not necessarily one-year volatility numbers, but the probability that we reach our goals over that long term. And by getting to policy, both we believe it'll increase both the median outcome and the outcomes in the downside scenarios. And so I think that's really important as we're thinking about what the future asset allocation looks like. There was a lot of confusion about the slide 5 on cash flow, so I wanted to spend a little bit of extra time on this. BERS ran its first cash flow study in 2019 and a subsequent study last year. It is important to understand that our cash flow analysis are point-in-time estimates. So they're given our assumed rate of return and for a closed plan, so it doesn't assume any new members. What we wanted to convey was that, and I think we can do a better job of this in subsequent breakdowns in subsequent months, is that the employer contribution may not be as responsive to market downturns as you would otherwise think. And the reason for that is because the smoothing of investment returns, so the smoothing of the returns above or below 7%, and the normal cost, so the cost of the plan of one additional year of service that the city puts in, are not the only elements that are within the contribution that the city makes. Importantly, changes to the actuarial assumptions are a large component, or can be a large component, of the city's annual contribution. The amortization of the drop in the discount rate, so the change in discount rate from 8.25 to 7% over the past 11 years has been a factor in the employer contribution. And as that amortization of cash flows declines through 2023, the cash flows will decline more than would otherwise be, would otherwise see if we were just using the investment return smoothing and normal costs. And that decline goes through 2033. And then the cash flows rise in the out years pretty rapidly. Again, this is all as things currently stand. We do not know in the future, obviously, and a prolonged period of returns that are lower than the assumed rate of return will, of course, change those projections. But I think the biggest takeaway is understanding that amortization is ending, and so the cash flows will drop more than you would otherwise think, given just the changes in returns and the additional normal cost to the fund every year. And one of the big things when you're thinking about cash flow and why the shape of our cash flows is important is that understanding if we hit a market downturn right as cash flows are going down, that certainly will have both an effect on the overall funded ratio, and it'll take years to kind of catch up as investment returns are smoothed into the contribution rate. Slides 6 and 7 in the appendix discuss our analysis on active management as it relates to large cap international stocks. I think this analysis is relatively straightforward, and this is the implication is that just as in U.S. equity, where we are almost entirely indexed, international large cap has kind of been proverbial no man's land when it comes to excess returns and risk in alpha. Over a full market cycle, we've seen deterioration in active management And so on a risk-adjusted basis, it has not added value. As you saw, actually, in the good years, Bailey Gifford did fantastic and drove the outperformance. Of course, we've given most of, if not all of that, back in subsequent years. Given that, I think consideration of additional indexation in our international large cap portfolio is warranted. And then finally, and this was not in a slide per se, so I did not put this as NA for a slide, but it colors all of our commentary and how we believe the board should approach asset allocation. So as of 6/30/2022, it is our estimate that the fixed tax deferred annuity accounts for 28% of the total assets, which has a large leveraging effect on the qualified pension plan. I think increasingly outcomes for the funded ratio of the qualified pension plan, for the DB plan, will be determined by inflows and the growth of the fixed TDA. In good times, that means that we have huge net gains in our funded ratio and huge kind of eye-popping returns. So for instance, for fiscal year ended 6/30/2021, that means a 28% return on assets, on total assets, means a 36% return for the qualified pension plan. Of course, we see the downside of that as well in subsequent years. For the fiscal year ended 6/30/2022, a minus 9% return on assets is actually a minus 14% return for the qualified pension plan. Just doing kind of standard analysis using some of the work of the actuary, some work from Salil. If we hit projections of returns on assets and returns on the outflows from the QPP, which again, we went cash flow negative in 2020, and inflows to the TDA, so not just the returns, but additional contribution to the TDA, realistically, the TDA could be a third of the assets within the next 5 years, maybe 5 to 10 years. And so how we think about that embedded leverage, how we think about how much in alternatives we allocate over the next asset allocation cycle, all that should be thought of in the context of the interconnectedness between the funded ratio of the QPP and the growth of the fixed TDA. Again, not saying that we shy away from the fact that at the end of the day that those are the returns that we have to get, but it should be included in subsequent asset allocation presentations now into the future. And so these are constantly evolving conversations. And like I said, as kind of questions flow in on, as we are presenting certain types of analysis and how that relates to the funded ratio and performance of the plan, we'll continue to try and generate tables and graphs and charts that can boil down the main statement, the main the main input from the analysis, the main statement, kind of what we are saying with this information, and then subsequently how that should color your decision. Not necessarily what the decision should be, but how that should modify the outlook, given our goals of maintaining a high funded ratio, incorporating the policy statement, and working within and with your investment advisor. So how all that works together, I think, is incredibly important. And just wanted to boil down those main takeaways from last month's presentation as we go into the asset allocation cycle with the Bureau of Asset Management and our sister systems. So that's really the kind of the crux. Obviously, you have this material. If you have any other questions on that material, on any of these statements, or how we think that should color your decision making, happy to discuss. So any questions before I turn it over to Salil?
Antonio, if you mind if I jump in with just one comment?
Absolutely. No
So,
problem.
so these combined impacts are among the things that differentiate us from the other 4 systems in New York City. TRS has a TDA which leverages their returns. There is a parallel there, but the fact that we are so well funded from cumulative returns in our portfolio makes this significantly more important for us, because the responsiveness of contributions from the city are far more predictable for us, given our funded ratios, which is a good thing, but it will definitely impact our cash flows for the long term.
Absolutely.
And just something to be considering when we talk about differentiation between us and other city plans. this is the foundation of it.
Well, thank you. And so currently we do, and we might want to pick up do something every year. Currently, we work with the actuary to do a cash flow analysis. Again, always considering it's a point in time estimate. But we do that every 2 years. And so, we got the last one later last year, first one in 2019. And so we will be able to modify. One thing we might add is for right now it's a point in time estimate, and then we kind of have to do the estimates over, if we get a 5% return versus a 8% return, annualized return. Subsequently, in discussions with Merrick, we might be able to do more. And so to give kind of both kind of the projections and maybe a 25th and 75th percentile, projections there as well. We do that now with the liability model, like the asset liability study that we did with Siegel Marco. But right now we're only giving kind of one output in the cash flow analysis. We may be able to do more in subsequent years. Perfect. Well, I'll stop sharing my screen. And so the next item for discussion is actually Deputy Director Salil Mehta will dive deeper into the asset allocation and risk, focusing on current return assumptions, how to think about and prepare for situations where asset returns are lower than expected, and alternative methods of determining asset allocation. So, Salil, I'll now turn it over to you.
Great. Hi. So in this presentation, it's going to build off of prior presentations I've done on basket clause, as well as I've done 2 bear market analyses, the most recent being last month. The reason for doing very sort of additional asset allocation analytics is so that you're able to answer sort of as an organization very specific questions on specific investment governance, and have a sort of a way to reconcile the biases that Tony showed and I've shown previously in returns, and also get down to questions that come up like in international things like how to put together the developed market portfolio, how to incorporate basket clause, and all that sort of rolls back to having additional views on asset allocation and funding ratios. So I'll probably be doing more follow-ups on this, as appropriate. But for now, let me just share my screen and let me know. If you can't see the PowerPoint, just say something. Others assume you guys can see this.
Yep, looks good.
You're good.
All right. So right now, one of the more recent rate of return assumptions for the entire plan is at 6.3%. That's a long-term 20-year projection. A lot of folks may think of this as a very specific value, one that you're definitely going to get. And certainly if you don't get that in a particular year, over time, you're going to get that. What folks probably don't spend enough time on is that historically there have been errors around that value. Those errors wind up being the basis for also incorporating some degree of standard deviation or standard error around that forecast. So in addition to the 6.3, there's a published value about how much it would vary. And so instead of showing a normal distribution here on the bottom, I've shown a simulation of 5,000 possible outcomes. That way you kind of see things in different ways. Instead of seeing a nice theoretical curve, you see something where even if you have 5,000 independent views, which you'll never have that much sort of when you're doing this sort of modeling, it's not necessarily as curved. Sometimes it's clumpy along the way. But in any case, what I show here in the arrow is that a plus or minus 3% error around 6.3 soaks up roughly 70% of the outcomes. 30% would lie outside of that. It's a very large range in terms of possible outcomes for the pension. And another byproduct of this sort of calculations, if you take 2 lengths worth of error, so plus or minus 6%, you have a very wide range between 0% returns all the way up to a little over 12%. And that would take in maybe 95% of future outcomes, and you still have 5% that are on either side of that. Now, with the historical bias that we've seen and just our internal view of what we might expect from returns, it could be something a little less than 6.3%. And I demonstrate what that might look like right above. I'll call that an alternate view on one single baseline view down here. Now this is centered more closer to 5% returns as opposed to 6.3, and it might seem like, well, that's just a little bit different, but you can see the large variances that overlap both of these. What's shown above, this alternate view, also incorporates this idea that I've talked about previously, this sort of lost decade or lost decades, where you have a regime that has low, historically low returns, and it's not actually that much of a leap that you might get there, because even in your baseline, there is a 1/3 chance that when someone says 6.3% return, it's really going to be 5% or less anyway. Additionally, what was important that's been talked about in previous presentations is that that you need to have returns that are around 8.5% or higher nominally over the long run in order to have a funding ratio that actually increases. If you get something less than that, it's either going to be flat or down. And the probability of having literally just that, a flat or down on the funding ratio, or the probability of being less than around 8.5%, is quite high in the alternate scenarios, 80% or more, but it's even high on our current baseline, the industry sort of distribution of expected returns, which you see down below. So what I show here on this is that to get to this, say, in the 5% range, this alternate view, which I show in red bars, it's not a uniform lower expectation across the board on every asset class. There's slightly higher potential disappointments in asset classes like emerging markets and private equity for different reasons. In emerging markets, because we've historically have seen these disappointments and may continue to see them. And in private equity, the volatility has not yet been incorporated into the models that generate these returns. And as they do, that would, in conjunction to its high correlation with US equities, be a potential place for additional slight revisions down. And a slight pickup on the other end of the spectrum in the more fixed income areas. So if you kept your asset allocation equal to where it has been in recent years, but then you reduce your return expectations, obviously you'd go from around a 6.3% down to around maybe 5.7, around 75 basis point reduction in return assumptions. However, this is the reason why, if you have additional perspectives on where you might want to change your allocation weights or bias decisions, you can get those returns back up, at least claw back maybe around half of that. So a couple of the arguments that are widely used to defend, say, emerging markets, and this is pretty wide. It's well outside of the New York City pension plans. There's the defense comes to the diversification benefits and other things. So the first is the diversification benefits. So I'll show the same asset classes, and I'll show in the brown bars what is the actual diversification benefit of each of the asset classes to US equities. A -1 correlation between that asset class and US equities would be a perfect diversifying benefit. None of the asset classes actually are even negative. But the ones that are the highest and therefore have the least diversification benefits are actually the ones we're talking about, the ones with the allegedly high return, high disappointment sort of historically, and also they have the highest correlations to US equities. What I show in gray is what is a statistical concept which basically takes into account the partial correlation, or what is the diversification benefit of that asset class to the entire portfolio, not just U.S. equities, but collectively all of the other asset classes combined. And again, the least benefit from the introduction of, say, emerging markets equities in general is somewhat high. So you have to make a decision every time you introduce a new asset class, whether it's a commodity, a currency, whether it's venture capital, anything, about whether that asset class itself is going to be a diversifier or not, versus some of the other asset classes. And on this side, again, we have some of the fixed income. I'm going to just make a side comment on one, because in a future presentation, we'll go deeper into things like the development of the developed market portfolio. But the developed market equities as an asset class has the highest correlation to U.S. equities, other than the trivial case of U.S. equities versus itself. So 0.9. And if you think of the two large buckets within developed markets, if you think of developed market large and developed market small cap securities, they have over a 0.8 correlation with one another. So you're dealing in a very highly multi-correlative space where the factors, the managers, and the asset class themselves are extremely correlated and have the least diversification benefit to the rest of the portfolio. So I just want to sort of bring this up as one thing in terms of, and this doesn't matter how you calculate diversification benefit. I've looked at this correlation on a daily basis, monthly basis. I've looked at it on an annual basis. I've looked at it in different arbitrary time periods, and over long periods of time, multiple cycles and low cycles. The answer is virtually stable and the same. The second issue, and this is for internationals and emerging markets, is that, well, you could have had a currency strategy that coupled emerging markets, and then you would have extracted this excess return. You've extracted positive returns in general as you repatriate the returns back to US dollars. So that is obviously backward looking. You're sort of saying today, well, something didn't work out that was supposed to work out, but had you taken something else. But going back in time, there's not been sort of an industry implied or explicit recommendation that the hedged strategy would have outperformed. There have been return assumptions that have shown actually the opposite, that an unhedged strategy would outperform the hedged strategy, and then the unhedged strategy, of course, has not worked out, and that there is a inherent diversification benefit by using a currency aspect to this, but that it's weak and is overly dominated by the fact that a currency strategy coupled with, say, an emerging market manager would actually increase the volatility associated with that asset class, and that would overly dominate the inherent diversification benefit. So if you were to say, okay, now I want to take it still idiosyncratic, or you could have taken an idiosyncratic bet that even though emerging markets unhedged has historically not delivered returns, you've had actually 2 lost decades, 1 lost decade in developed markets, but for emerging markets, 2 lost decades. But you could have extracted returns only if you put on a currency strategy. That means the sole source of your excess returns is actually on the currency side, which is a very different and pricier sort of return and risk characteristic associated with it. Now, let's look at the asset allocation. This is just a format. You can see it's just the numbers with all of the different asset classes in a tabular format. This is most recent one. I started several months ago, but the most recent one I had here on the left. And then here are the market values within our current portfolio. As you can see kind of how they differ. Again, a recent perspective on what the returns and volatility is. taking into account an alternative perspective on the returns and simulating out correlation and covariance respectively, you would have an optimal asset allocation shown here on the right. It doesn't vary that much, maybe in this tabular view, which is why we're going to show it in different ways. I mean, you've seen it in a pie chart and bar charts and maybe other presentations, but the one thing to notice is that the large differences, perhaps, is that you get a little bit of a tick up in private equity, even though I sort of mentioned before, you might take a slight revision down on those return estimates. And that's only because it's still the only asset class that has an expected return, even after the revision, which, conservative revision, that still hovers around 8%. And you're looking for those types of returns in the objective function that would be at 8 or higher just to maintain your funding ratio. So it's that's kind of why that one goes up a little bit. Conversely, for core fixed income, it comes down a little, even though you might expect with the sort of unexpected, quote unquote, higher yields that you have now, you might get a performance in that space. So this is one view with one specific rate of return assumptions for emerging market. There's a lot of different perspectives on what the emerging market returns should be. There's literature, different strategists will have house views. Everyone's got a view, and everyone's view is a crystal ball, and it's or it tends to be a crystal ball, but it's no one knows, obviously, with certainty. It could be 8.6, which is where it's currently in the most recent return assumptions and asset allocations, 8.6. It could be the 6.6 that I mentioned. It could be 0, and it helps to see how you'd vary your asset allocation for either this asset class or for others, depending on a robust variety of different future return assumptions. So I'm going to show. So this is at 8.6. This is a tree chart. It's basically, instead of a pie chart, it's shown in this way. You can see the different slices of asset classes. Here's your emerging markets. And you can see as I reduce the rate of return assumption from 8.6 all the way down to 0, you would expect a smaller and smaller amount from here. I'll freeze it at 8.6%. And right now it's sitting around 6, but if you were to drive down your return assumptions, then you would be able to expect maybe a smaller amount. Only half the pickup will come in core fixed income. Almost the other asset classes will stay fairly the same. This is very similar to what you would do in private equity and other places, although, of course, with private equity, because of the high return expectation, it wouldn't decline as much. So it might be a little confused, but I want to sort of talk about what you just saw a little more. If you keep or believe that the baseline return and various assumptions that are built into the asset allocation model come out to be true in the future, and that would include an 8.6% return for emerging markets. If you believe that and believe that that actually will be what happens, that there's no variety based on errors or randomness and so forth, then the current 5.5% EM allocation in the portfolio, collectively with the return assumptions, would give you the 6.3 that I mentioned rate of return for the pension. And on the other hand, if you were to reduce the allocation, say you took your emerging market allocation and today instead cut it in half, even if the baseline assumptions are true, you would still get a little bit of a higher return, only because you've redistributed the remaining allocation in other places that were more optimal. Now, on the other hand, if we follow a future path that is different, has perhaps lower returns, slightly closer to 5%, let's say a lost decade or two, and including a 0% return in emerging markets, then keeping our current asset allocation as is would lower the overall returns. Instead of getting 6.3 assumed, as promised, you get something closer to 5.3. But had you made that reduction in emerging market allocation to 3%, you would obviously decline from 6.4, but not decline as much, and you'd still be higher than in our current asset allocation. So in other words, you are getting a better return regardless of a wide variety of future market outcomes, not just one specific one, but a variety. And you can infer this across others asset classes, and also the module that I showed before can actually be built out so that you can look at multiple asset classes or different scenarios of economic scenarios and other things, and see sort of what would be a better blend for the pension, a better augment, and also be able to perhaps, because of the techniques used, be able to extract maybe a little bit extra excess returns just through the asset allocation component. So the conclusion here, this takes the asset allocation process, augments it using additional statistical approaches, and it yeah, and so I mentioned some other things down here, but hopefully provides the sort of directional perspective on what you could do, and potentially can ask and get additional sort of information, a little more real time, and more dynamic, sort of, especially in between the asset allocation generation and based on what's happening in the market, or if there's a legislative question that comes up or so forth, you can kind of play around and get some perspectives quickly. So that's all that that I have for this presentation. Are there questions? I'm going to stop sharing so I can see people. But
Sure. So, I mean, the lost decade that you mentioned at the beginning of this presentation, is this something that we think is likely? I mean, the clearly we're at some inflection point in the market, but the lost decade sounds pretty scary.
yeah, okay. I'm trying to go ahead. Sandy, did you have?
Could I? Yeah. Let me jump in. So, Ben, we started this analysis because we saw near-term disappointment in international stock allocations, right? And so what we did was say, okay, well, what the hell's going on? And Salil went back and looked at assumptions over the last decade versus returns, and we found while the assumptions driving our return estimates indicated emerging and international core markets would outperform the U.S., we found the exact opposite, right, over a 10-year period. Well, okay, so if you believe in mean reversion, then let's look 20 years. 20 years, because you're going to get some cycles, and you should see the expectations for these returns rationalized, right? No, that's not what you found. We found generally a repeat of the relationship where expectations were higher than the actuals, right? So the question becomes, if
By the way, Sandy, I'm sharing screens related to what you're saying, if that's
yeah, I see that. Thank you, Salil. So if the rubric or the capital asset pricing model says that international stocks are an incremental return benefit and an incremental diversifier benefit, the last 20 years says neither of those things is true, right? And so then the question becomes, and this is a rhetorical, more than a rhetorical question, Okay, well, let's say that 20 years is an anomaly and the capital asset pricing model assumptions are still valid, and there should be a tremendous return advantage in international securities because of a mean reversion move, and call it the next 20 years, right? Okay, well then, what scenario can you imagine where international public markets outperform US public markets if in the history they have not? Right? So what does that environment look like? And then if you have questions about that, and then you have to go back and say, okay, well, is the capital asset price, are the assumptions upon which we build these forecasts valid? And it raises the question of whether the model misses some risk profile or risk exposure which is not being measured. And I'll credit, I think it was who said this? It might have been Schroeder's or something in the last few months, that they're starting to look at this stuff and they're quoting an autocracy risk function, and they're trying to measure autocracy risk. So to the extent you have a managed economy versus a capitalist economy, and the capitalist economy has internal corrective mechanisms which are independent of top-down decision making, if that is more flexible and returns are better than in a managed economy, then that might explain it. Don't know. I mean, it appeals to me, I have to tell you. It appeals to me. But you don't know whether that's what's going on. So that then you're back around to the question, right? Should we have a 15% allocation to international, right? And then, so then you layer over some other questions, which was already spoken about. One, has active management in international been a benefit historically for us? The answer is a clear no. Secondly, if we use is it 5 percentage points of our basket currently for international?
We're six right now.
Six. You know, is that a useful use of our basket? Right? Well, it suggests no. If we accept some of this return analysis, it suggests no. That 5% allocation, which would drive down our exposure to 10%. Right? So it's like a three-dimensional question, right? You have the issue of actual returns not marrying up with the historic analysis. You have the pressure of active management, which has not been successful, and the pressure of the basket clause, which a 5% allocation has deteriorated our returns. So it's like if you look at the sum and substance of all these things, while there's still questions about this, I mean, you can never be sure. It has suggested to us that, you know, we need to reduce our international exposure. We should look at indexing it, and we should look at freeing up our basket so we can use it. And then that brings in the next dimension, right? So, you know, this actually becomes another level of conversation. Let's assume the 35% basket clause legislation is signed by the governor. Given that, what would we do? And then that raises the question of future cash flows, leverage in the portfolio, and brings in a whole new conversation that is, it's a long one. But it's like, you know, the first level is international exposure, I would argue. And that, you know, I know Salil has derided me for saying, you know, 5% or less, but I guess that means I'm a big capitalist.
I wanted to mention, this is the asset classes that I've highlighted in turquoise here are those that are associated with the basket clause. These are by the legislative definition of alternatives. And you can see kind of where if you were to be more free bound, where you might want to set your new weights. And what I've shown before, early on, before getting into the math, is that you probably would never utilize all the way up to 35%. You might increase your overall basket clause weights by several percent.
Right. Yeah,
Got
that's
it.
separate from a current utilization of the 25% basket. The utilization of a 35% basket brings in questions of cash flow, leverage in the portfolio, and our funded status, and whether we should take that risk. I mean, there's a reasonable debate around that question.
Got it. Thanks, guys. Appreciate it.
Sorry, I jumped in there, Salil.
No, that's good. I mean, it's really for you guys to discuss if there's other questions or conversation. There's, I think, more time this go around than the last presentation.
Any other questions for Salil? Or, kind of just in general, and I said, we'll continue to have these presentations. Again, I think, understanding, and a lot of this is on the margins, right? And so it's not necessarily wholesale changes, but, and, last time we talked, when we saw, Salil's kind of regime switching slide, right? I think that is also, again, as I reiterated countless times, an incredibly important aspect, right? That as financial asset returns decline, we're going to have to ride. I mean, there's a chance again that we have to ride that entire wave down. And so, what does that mean for us? Again, we're in a good financial position, so it's not. I wouldn't necessarily things are, dire or particularly scary, but it does say, even marginal changes can be helpful as we're setting asset allocation over the next few years. And like I said, being able to incorporate liabilities and cash flows into that analysis, I think is where we want to really concentrate on, because it'll give you an idea about because even a different funded ratio, similar funded ratios with different cash flow profiles can mean different things, and so that I think is really important. But thank you, Salil. Any, like I said, going once or twice for questions for Salil on this particular analysis.
I don't have any questions. Thank you, Antonio, and thank you, Salil.
All right, that is the last item for public session. The last agenda item is a discussion on individual investment funds for consideration, which belongs in executive session. May I have a motion to enter executive session?
So moved.
All right, thank you, Ben. Do I have a second?
Second from John.
Thank you, John. Any final discussion? Before I ask for the vote, just want to note for the record that Sarita Scott is in attendance as well. So all those in favor of moving to executive session, please say aye.
Aye, John.
Any other ayes?
Sarita, I think you got to do it for me now since I'm your alternate.
Just about to ask. Yes, I,
Yes.
Sarita.
Aye.
Sorry.
Thank you. Any opposed? We are now in executive session. I will pause the recording. Right, we are now in public session. In executive session, the executive committee approved a commitment to a private opportunistic fixed income fund. It's the last item on the agenda. Before I ask for a motion to adjourn, just a reminder that the final executive committee meeting for the calendar year is scheduled for Thursday, December 15th at 1 o'clock. There's a lot to cover in that meeting. And so that's where we'll see the annual pacing plans, a few managers, and so forth, just to give you an idea. So we'll try best to start on schedule to get you all out in the 2-hour time frame. But just a heads up that, and you'll be seeing the agenda in a bit, but we'll see, we're going to do the annual plans and several investment funds. So again, try and make it on time to get out on time. All right. So is there a motion to adjourn?
Motion from John.
So moved. Yeah, second, John.
All right, thank you. Any final discussion? All right. All those in favor of adjourning, please say aye.
Aye, John.
Aye.
All right.
Hi, Sarita.
Perfect. We are adjourned. Thank you. See you all next month.
Thanks so much.
Take care, everybody.
Have a good weekend.
All right. Bye all.